Hello, my name's Alex Davies, founder of Wealth Club, and today I'm joined by Tim Levett, chairman of NVM Private Equity. So first off, Tim, perhaps you can give me a brief overview of NVM.
Yes, certainly. NVM was formed in 1988 by three of us and has been managing VCTs since 1995 alongside a quoted investment trust focused on unquoted investments. Since 1995, we have raised successive VCT funds, and between 1995 and 2015 we were investing in a mixed portfolio. Currently we have 215 million under management in VCTs and a further 70 in a limited partnership for high net worth individuals and institutions doing MBOs.
So NVM is one of the most popular VCTs available. We've heard stories of people getting on a plane to Newcastle just to get their application forms in on time. Why is it so popular, and what exactly does this VCT do for investors?
NVM's been going a long time and our investors have stuck with us pretty much from the beginning. We have very few share sales, very few buybacks, and the reason is that over a long period of time we've paid in successive years very steady dividends based on realising investments and the income that we have derived off investee companies from loan stock. And they come back for more.
And what makes NVM different from other VCT fund managers?
Obviously, the rules have changed, but prior to 2015, we were investing in a mix of companies, some early stage and some a lot more MBOs. And typically on the MBOs, we were backing incumbent management teams in businesses where we thought there was a growth opportunity. And then going forward, in other words, from now and where new investors' money will go, we're looking for the same type of thing. We're looking for management teams who've been in the sectors in which we're investing before, have some measure of success, have produced a product or service which is sufficiently differentiated to have a place in the market, and a market in which there's a growth opportunity.
So can you give me some examples of recent investments you've made and what attracted you to them?
Yes, certainly. I'll give you three. There's a business called Sorted, which is a parcels logistics software business with a very unique product which manages to link manufacturers distributing goods with various forms of logistics and transportation. And the reason we backed this business was we were very impressed with the software, impressed with the young man who was running it, and they were on the cusp of winning a contract with Dyson to distribute Dyson's products worldwide, and they've now got that contract and are delivering it. Another one is a business called Rockar. Rockar is an e-commerce automotive business, a very novel piece of technology where they have a thing called the buy button. Manufacturers are linked directly with consumers, enormous efficiencies, great online specification of the car remotely, and then a link in with the dealers so that the dealers get the service. And this was founded by an entrepreneur from the automotive sector who has placed £2 million, so money where his business plan is. A third one is completely different. This is a business in the social media sector. This is a business called Channel Mum, founded by an entrepreneur, a woman who had founded Net Mums and sold out. She had a vision that the type of community site she was doing for young mothers, millennials in fact, was going to move towards video, and she had the vision to set into that. And in her first complete year of trading, she's turned over £1 million, and brands are increasingly going towards her and away from television. So the common factor in all of those obviously is the people, and the second common factor is there was a differentiated service, and we believe there's going to be a good market.
So the VCT rules changed in 2015, which has meant that things like MBOs, which you're heavily invested in, you can't invest in them anymore. Obviously it's quite a different way of investing. Why are you experienced to do that?
For a period of really the first 12 years, from 1988 onwards, in fact beyond that, more like 15 years, we were running a mixed portfolio of early stage investments and later stage, about a third early stage and 2/3 later stage, and I ran that. We had a number of notable successes. Business called DXS, which is a diagnostics company. We sold to QIAGEN for £100 million. Another one, a fintech software business, we sold for 53 million. So we had some knowledge of how to do this already, but we were lacking in knowledge elsewhere. And we recruited a very important guy, came from IP Group called Charlie Winwood, who'd got a number of good deals under his belt. Traxis is one in particular, Xeros, both of which were publicly quoted. And we've been working with him to build a team. So we've got the experienced investors, but not in the early stage, but understand the investment process. And we are building a team of people with tech knowledge to go with it.
Let's talk about exits. Perhaps you can give me some examples of recent successful exits that you've had?
Yes. In the MBO portfolio, we've had a whole succession of very good exits. Probably most notable is a ERP software business called Kerridge, which we sold to private equity at an extremely high price, around 70 million. We've recently sold a business called Optilan, which is a contracting business. We sold a business in Wales called Silverwing, which was a non-destructive testing business. We have had a general trail of disposals from the portfolio, averaging anywhere between 2 times and 4 times our money. And they're the investments which have underpinned the dividend our investors have so enjoyed.
And is there anything that hasn't worked out quite so well?
Yep. We had a very difficult MBO in the modular building space called BritSpace. We invested in there prior to the financial crash. The business was very project driven, very dependent on the public sector. We were building hospital extensions, schools, prisons, and after the financial crash, work from the government dried up, and we were pretty heavily indebted to the bank. So unfortunately, we were the victim of a change in the market.
Very interesting. I'm going to invest in some VCTs this year. Why should I invest in yours?
I think you should invest in ours because we are very experienced as investors. We're investing heavily in augmenting what we've got in the team with more technical skills. We will also be building a team of non-investors, people from social media, salespeople as well, to come in and help the businesses in which we invest. And we're there for the long term. And indeed, if it's any comfort to people, we have 5.5 million shares that we own in these funds. And in this round, we're investing 900,000, and I'm keen not to lose my money.
This is the first fundraise for some time that's actually allowed new investors to participate. Now, is this a opportunity, a now or never opportunity for new investors to get into this fund?
I think it's a good time to get into the fund. There is obviously uncertainty about what's going to happen on November the 22nd at the budget, and clearly at the moment the initial tax breaks are there and the investment opportunity exists. So I believe that now is a good time to be in. I believe we'll have a lot of liquidity in the fund at the end of this year, and this will give us the ability to build a portfolio of around 40 companies, and we will be investing shareholders' money at around about 30 million a year. So the money will not lie idle with us for long. It will be deployed.
And would you be expecting to raise again next year?
No, because we are raising, effectively this year, we're raising 2 years' money because of the uncertainty in the budget. So we are not intending to raise next year.
Thank you very much, Tim Levett of NVM.
It's a pleasure.